Happy Finance Friday. The Chief Operating Officer at First Ontario Credit Union, Mark Perkins, joins us with a very hot topic today, mortgages and renewals. And actually, we have a viewer question. This is from Sharon in Dunnville, who asks, Mark, our mortgage is up for renewal in June. She says, with interest rates on the decline, should we renew long-term or short-term? And what interest rates are in, and see what interest rates are in 2025. Or, she asks, is a variable rate mortgage a better option? Great question, Sharon.
Yeah, and it's very topical. I'm sure every bank and credit union across the country is having this on a daily basis right now. So interest rates are projected to go down, but the question is by how much and when? So you've got to ask yourself a few questions. You know, are you looking for a straight renewal? Do you need to refinance? What's your risk tolerance? But most importantly is, are you prepared for the payment change that is going to happen? So, you know, we can walk through an example. If you have a $300,000 mortgage at a 4% rate, your payment right now is around $1,600. A one-year fixed rate right now is around 7%. So that payment is going to go from $1,600 to $2,100. A five-year fixed rate right now is around 5.7%. So that payment would be around $1,850. So no matter how you look at it, there's going to be a payment increase. From a variable rate perspective, you know, over the life of mortgage, historically, you're going to pay less interest in a variable rate mortgage. That's over the whole life of the mortgage. But there's some pockets and windows when that's not true, and we're in one of those right now.
Yeah.
The other thing is, you know, cost certainty is important. So if you're a risk adverse individual like me, that cost certainty of a fixed rate allows you to really plan out longer term with some consistency.
Okay, and I guess the gamble always is, you know, if rates really go down and you're stuck in a fixed rate, you know, is it worth the penalty of getting out of it to go down to a lower rate?
Yeah, absolutely. And when you were coming in 2018, 2019, 2020, that was the case. A lot of people were breaking their mortgages because it was in their best interest because rates were so low.
So low.
Yeah, to take advantage of it. And, you know, we're not going to see rates that low maybe ever again. We're talking about, you know, 1.5% variable rates, 2.3% fixed rates. Just like we're not going to see the 1980s again, which is 14 to 20% interest rates.
Let's hope we're not going to see that. Yes.
Yeah. But the long and the short of it is, if you have a mortgage, you need to be prepared for your mortgage payment going up on renewal.
And there's stress tests too, right? And you should always, I guess, not go to the very limit of what your budget is.
It's easier to say than do sometimes.
I know.
But yeah, so the government put a program in maybe about 10 years ago. When you qualify for a mortgage, you're qualifying at a rate 2% higher than your contracted rate or a floor rate that the government established. So from an affordability perspective or from a qualification perspective, you can afford the payment coming up on renewal. But that's not necessarily from a lifestyle perspective. So let's talk about some options you have in your toolkit for some payment relief, right? So you could extend your amortization, so that will immediately give you some payment relief, paying your mortgage back over a longer period of time. Subject to qualification in today's interest rate environment, you could refinance, take some equity out, put it on the sidelines, and use that for some payment support and payment relief. Again, that's payment support and payment relief, not lifestyle support and lifestyle relief.
Yeah.
And the last one, and probably most straightforward, is the HELOC, the home equity line of credit. So you renew your existing mortgage as is under one of those scenarios, and then you add a line of credit using some of the equity in your house to facilitate some payment relief. And that's really important if you have an insured mortgage, because if you extend your amortization or you refinance, you're breaking that contract, which you paid an insurance premium for on origination. You know, at the end of the day, you want to get advice, you want to talk to the experts, and you want to start early, you know, 60, 90, 100 days advance, because the last thing you want to do is be up against the wire with a time crunch
and have to make a decision.
Yeah, and it's going to be the most important financial decision that you kind of make, the biggest financial investment you make in your life. So, you know, get informed, know your options, and make the right decision for you.
Okay, thanks for answering Sharon's question. And Sharon, thanks for asking. You can email your questions to financefriday@firstontario.com. And if your question or topic is covered on air, you'll get a gift card from First Ontario.